Welcome back to Trade with Conviction, your shortcut to making sense of the oil market without the noise, the doom scrolling, or the 50-page PDFs that you'll never read. So I'm back after losing a full week and a bit to the flu, which hit me harder than any market sell-off this year. So if you've avoided it, please teach me your ways. This is our final episode of 2025, and what a year it has been. So from Russian outages to record jet regrades, from contango scares to CTA pile-ins, the market has basically spent 12 months reminding us that normal is a fantasy and volatility is a feature, not a bug. So look, to help me make sense of all the madness and to set us up for 2026, I've got a full quorum on the pod today for you guys. So Neil, James, Jorge and Phil, it's your last pod duty of the year. Let's make this a good one, please. And hi all.
Hello.
No.
All right. Okay, look, we're going to cover the latest headlines, the geopolitical curveballs that everyone's watching, and then break down where the physical market actually stands as we head into Q1. So look, let's get into it. And as usual, why break a habit of a year? Let's start with the headlines, because honestly, it feels like the market's been asked to digest 5 plot twists at once. Venezuela, Ukraine, Brussels, US jobs, China slowing. How do we even begin to make sense of this, Neil?
Yeah, let's start with Venezuela. That's the obvious one. And it did, in the end, do what was threatened last week. So there was one tanker seized last week, and then it seemed like there was going to be a real physical embargo, and now it seems like there's going to be a real physical embargo. The wording of the tweet, not a tweet, what is it? Truth? The wording of the truth.
The truth, yes.
is limited to sanctioned tankers, right? Which also seems to limit the scope, but I guess I would argue that kind of legality has not been necessarily a priority in the Caribbean in the last few weeks anyway, right? So who knows what can happen. In terms of flat price, it did nothing, right? There's Brent just briefly went above $60 this morning. We're back down below $60. I suppose that also partly reflects the fact that there's lots of oil around, and I think the market is wise to that. Increasingly, I hear from contacts and data bits around the web and things getting sent to me that the oil and water story is moving into onshore outside of China. So that will drive the market more than a bit of loss in Venezuela for the time being, unless something else really happens.
Fair enough.
There's a bit more Naphtha, Jorge. I guess you might want to pick that up later, but even for Naphtha, it's not the biggest story in the world yet. Is that also fair?
Yeah, I think that's right. Yeah.
Okay, and the other thing that's driving the market is, of course, Ukraine. And yeah, don't we love a bit of Ukraine? I honestly, I saw a statement that the US might be preparing more Russian sanctions next week in case a deal falls through. It's so bloody annoying, right? What are you supposed to believe? But increasingly, we should be skeptical of these statements and how far the US administration really wants to take sanctioning, including secondary sanctions. And to be honest, I don't know if you agree with me, guys, but I don't care about this announcement. I think Putin doesn't want to deal. Trump probably doesn't want to deal. I think he possibly would rather blame Zelensky and EU in case it falls through, because they are the ones holding the red lines. And there's a high chance that the thing falls through before Christmas, because I think that was Trump's next deadline.
Yeah.
And I guess the question then becomes, what does flat price do when that happens? Are we going to get another spike? Possibly, even though it changes nothing.
Does it really change anybody's base case, right? We said weeks ago that just because there's a lot more talk about deals and trying to make something work, it doesn't actually mean that anybody's red lines are any more compatible now than they were in the summer or any other time where this has been tried. So I'm not sure whose base case became deal and an end of sanctions, really.
Yeah. Do you remember a few weeks ago, who's becoming rapidly my favourite Substacker is this guy, Phillips O'Brien. And
I get daily emails of him now, by the way, which is great.
Yes.
So thanks for that tip, Neil.
On the very off chance that he listens to this thing, thank you very much for all your insights. But he noted that there was an article in Vanity Fair basically about Susie Wiles, who's the White House chief of staff and Trump's fairly close ally. And she basically stated Trump has known even since before Alaska that Putin wants all of Ukraine. And so even sort of this ceding some territory in this deal is probably not enough for him. Or it might be, but then we're back to square one and, there's chance of escalation again in a year or two when Russia's got themselves together again. So I think the chances of a deal are pretty slim still. And that's what the market's kind of talking about now. The CTAs are already max short. We've already had a sell-off. Is it easy to trade this further lower? I don't know. I don't know. I think there's a chance of both directions just now.
You really think Putin wants to drag out this war much longer? You think he really wants all of Ukraine? Like, to hold it for decades? I mean, surely there'd be like huge terrorism attacks on military personnel if you tried to hold the whole of Ukraine, right? That's a real fantasy.
I don't know, of course, right? All I can do is relay that there's a difference between what the experts are saying about Putin's state of mind and Putin's wishes. That includes former heads of MI6 who have just retired from the UK saying there's no chance of Putin wanting to do a deal. And so, people are quite rightly saying all of this is just theatre. All this kind of deal breaking is just theatre just now because the red lines are still there for basically all sides.
One thing's for sure, we're still going to carry on talking about this in 2026.
Yeah. And if the deal falls through, of course, we've already had attacks on CPC. Ukraine's attacking Lukoil platforms in the Black Sea over the last couple of days. This Filanovsky platform got attacked. So, it's again a tricky one, right? I have the feeling, and I was going to talk about it later, I have the feeling the glut is now here because I increasingly hear from people, hey, look, it's showing up in onshore inventory. Not even in the US, because in the US it's kind of pretty mixed still. So the glut seems like it's here. I suppose that will drive pricing further unless something huge comes along, but it seems like the chance of that happening is still pretty big, so hard to trade again.
Fair enough. What other news have we got in the headlines?
I was going to talk about the EU, but what's the point? And then there's other things that came out, right? The US jobs data was on the...
Yeah.
Well, I think I'm more bullish on Europe than many people. I think our institutions are slow, but eventually, I just wish we would move faster. Like this story about freezing Russian assets. It just feels like, come on, take the initiative. Stop running from crisis to crisis when Trump proposes a new ceasefire that we all know is whatever dodgy. Yeah. And why can't we just take the initiative and get this over the line? And part of the problem is dissenters within the EU itself. Yes, we could talk all day about this, but let's see how it goes. I'm still bullish Europe. Okay,
good. And what about, have we had any data sets through in the last week, should we say?
Yeah. Well, obviously there's just into year end. I was going to, at some stage, do this sort of story of like, it seems like tariffs haven't made that much of an impact on the economy, but it depends on which week you're reading the news. And it feels like the Chinese industrial and consumer indices are actually easing quite substantially into year end. The US jobs data in terms of payrolls is okay, but unemployment is rising. Various measures of unemployment is rising. So I don't know, not my expertise at all, but there's also a black swan event where you get the markets crashing in, let's say, Q1, Q2, because it's becoming increasingly clear that the economy is not so hot. Plus, you're at peak oversupply. Who knows? There's still a chance for, I don't know, $30 Brent. Now that we're on the story of sort of wild prognostications, might as well do another one.
Oh, okay.
Anyway, US economy, US employment not doing that well.
Okay, brilliant. Maybe we'll revisit the $30 oil in January when we've all had a bit of rest and a bit of time to think things through. Okay.
Might as well.
Yeah, exactly. Thank you so much for taking us through kind of the headlines for this week, Neil. You may now grab some water. So look, let's move on to the physical markets then, because nothing says festive season like contango scares, narrowing east-west spreads and questioning refinery economics again. So look, we're going to keep this simple kind of throughout the physical market updates for you guys. So what do we learn in 2025 and what actually matters for the Q1 positioning? So James, I'm going to come come to you, actually. Why don't we start with distillates?
Yeah, 2025. Yeah, I struggled to cut this topic down because distillates really feels like it's been so topsy-turvy in 2025. But it feels like we start 2026 in a more bullish position for distillates than we started 2025. But as I said, it's been like a very volatile year for distillates. We've had ongoing low Russian distillate exports, fresh geopolitical tensions in the Middle East, Iran, Israel, and that all helped to push global distillate, or particularly diesel inventories, very low during the summer. For most of 2025, the gas oil east-west has been unusually narrow, mostly due to reduced Chinese middle distillate exports. And those factors pushed even the ICE gas oil July-August spreads to expire at $95.25 per ton. I mean, just a crazy number.
Yeah.
But then that strength in the barrel, combined with gasoline, I guess, moved into very strong refining margins. September, October were actually quite weak periods for diesel pricing globally, just before autumn maintenance. But then again, that ongoing reduction in Russian diesel exports, weak yields, announced tighter restrictions, sanctions on Russian material and logistics drove spreads to expire NOV-DEC 27.50 per ton. And then kind of post-maintenance, we had resurgent refinery runs, again due to refining margins. And then from $27 per ton, DEC Jan expired at just under $8 per ton. Yeah, well, in jet markets, also important to speak about. We saw some real strength late Q3, early Q4, largely driven by the outage at El Segundo refinery, which is very important for Southern Californian jet supply vis-a-vis Los Angeles airport. And that also drove then Singapore regrade to be at record levels for at least the last 10 years. And that closed Asian origin jet arbs into Europe and then flowed into, or meant, strength pretty much for the second half of the year in European jet markets.
Cool. Good roundup of 2025. So you started the chat, James, with you're bullish going into 2026. I love the fact that you're still on that bandwagon, by the way, but give us a heads up in terms of what does Q1 look like?
Yeah. Well, it's just, it feels like it's been so topsy-turvy this year that I've kind of been pretty bulled up a lot of the time. But so starting 2026, yes, I guess I'm definitely more bullish now than I was at the end of 2025.
Yeah.
So we've seen, well, to be fair, just towards the start of Q4, we saw quite some weakness in November ICE gas oil expiry, as I said, down to $8 per ton. But even that said, even with that caused by rapidly increasing crude runs and higher diesel yields and output, particularly in the key pricing centers, stocks don't really look that good, particularly if you look at PAD 1 and 2, ahead of what should be peak diesel demand in January and February in the Atlantic Basin, essentially. And the EIA came out of a revised outlook for temperatures in early Q1. It's going to be a colder winter than normal, which will only add to that demand as well. I mean, ongoing discussions, as Neil was kind of to speak about, with Russian-Ukrainian peace deal remain important to monitor. But this looks unlikely to be a meaningful solver for supply deficits in Q1, I guess, in time. So the base case for December and January is for impending tighter sanctions on Russian diesel and Russian crude-derived diesel and jet as well, particularly within the ICE and Platts pricing frameworks. Although Neil was kind of pointing out to me when we wrote this script, there's a bit of a contradiction between EU enforcement and the strength of US enforcement as well. So we've got.
Yeah, I would just say it seems like the EU ban is the least of our worries now, right? Because that involves, Reliance is already going to segregate, and the rest can be done by some kind of trade flow rewiring, whereas the market should be rightfully. I doubt there's many participants who really believe the US is about to strongly sanction Russian oil and has the goal of taking barrels off the market. If they had the goal of taking barrels off the market, although of course it's a very stupid statement, they would be doing things like embargoes like they're doing in the Caribbean, although you don't do that against the nuclear power, of course, but yes, I think there's a difference here.
And added to that, we've seen the continued narrowing of the gas oil east-west since about mid-November. It's really kind of moved back to its kind of seasonal averages now. And that should eventually start to point more Middle Eastern cargoes east, essentially, or force Europe, as I think is the case, to price up to pull these barrels and the gas oil east-west more convincingly west, essentially. Again, an important caveat there is that we should start to see in 2026 Suez routing to Europe over Cape routing increase in volume. So that's a possible bearish factor. But again, that doesn't seem like it's going to be a quick enough solver for Q1, essentially. the largest global refining maintenance period of the year is coming up again, end Feb, March, beginning of April, essentially. So are we going to build enough stocks before that as well? Basically, all that taken together, I think there's quite a strong case for being long Q1 diesel pricing, essentially. I always feel like we mentioned jet as a bit of like an afterthought, but yeah, we've got ongoing issues at El Segundo reflected in still elevated Singapore regrade. We're approaching like the peak Asian kerosene heating demand season as well, end of Jan, February as well. Yeah. And as a result, I think there's a constructive bullish argument for jet as well going into Q1. And it's not as if like, because of the strength in jet, that jet is going to really be easily blended into the diesel pool as a saver for diesel as well, because we're going to need those coal properties. And actually something else that Neil was kind enough to point out to me when I was writing the script as well is that kind of we've seen another bullish argument be that kind of low prices driven by Brent, I guess, should probably have some positive uptick on demand as well, which could only move into like a spike in gas oil cracks or a raise in gas oil cracks as well.
Yeah, I think that's fairly lagged though as well, right, in terms of the pricing options. So we might not actually see that play out until the end of Q1, I think.
Yeah.
From inland.
What we have seen in the past in kind of support of Neil's argument is borrowing from forward demand, kind of like prices dip so low that people take the chance to buy to fill up stocks.
Yeah. Okay, one to watch then going into Q1. Looking forward to speaking to you in January, James, to see whether this actually plays out as you say. Okay, on to Naphtha. So the market that's decided to be bullish, bearish and structurally confused all at the same time this year. So Jorge, do you want us to take us through a quick rewind of 2025 and the outlook for Q1 for you as well?
Yeah, of course. Well, I think that it has been a very interesting year. I had it in mind, but looking backwards at the charts and its behavior during this year, it has been really volatile, and we have many headlines and many unexpected movements in the market. But the levels nowadays are almost exactly the same that the 1st of January, both in time spreads and in cracks. But in between, we've seen every kind of movement. And I think I want to split the analysis of 2025 in two parts. They can be split in summer, in August more or less. So first we have the first 8 months, and then we have the last 4. And first of all, the beginning of the year, it was really, really bullish. I remember we were talking about a potential bull case at this time the previous year. But during Q1 2025, we saw time spreads and cracks rallying a lot in Europe and in Asia. And they were stronger in Europe, which has been the opposite than the second half of the year. And the main reason that we can find is on the petrochemical margins. So nobody was expecting 1 year ago the uptrend that we saw in ethylene and in propylene prices, especially in Europe. We saw a very bullish uptrend there. And it also took Naphtha physical prices in Europe higher. So the big headline for the first half of the year, especially Q1, were petrochemical margins and physical strength in Europe. The arbitrage didn't work for most of the first half of the year. Something weird if we take into account that this second half and this last quarter we've seen record margin levels from Europe into Asia. And also, this bullish uptrend was also combined with a strength in the gasoline market. Less strength than what we have seen in the second half, but both sides of the demand were pointing higher. So that's what we saw in the beginning of the year. Then, from August onwards, we've seen a totally change in the market. From Q1, Q3, we are starting to see some downtrend. So we are having far away from the maximum level that we saw in Q1, but we have a lot of headlines from the second half. So the petchem prices have collapsed. It has impacted every market, but we've seen we saw a strong turnaround season in Europe, mostly unexpected refineries, and also in AG. And then we have had lower Russian volume to be exported to the east. And combining all these two factors, they have been translated into a very strong east-west. Well, that's from the supply side. From the demand side, we have 7 new steam crackers in the east. So we've seen that in the balance for the East of Suez is much tighter, and it has taken its west to record levels, historical record levels, around plus 40 for several weeks.
Yeah.
With this, I think the historical average should be around plus 15 or maybe less. And that looks like the new normal in the market. We've seen that for 2-3 months, and we will expect to see very strong East West level for Q1 onwards. And and the other two indicators that have been in historical highs or historical lows has been PRONAP in historical lows, very weak during Q4, especially linked to the trade war between US and China, and also GasNap. We've seen a very strong trend of gasoline. Phil will talk about it, but linked to the Dangote and to the refinery turnarounds, and it has taken GasNap to new record levels.
I'm so glad. I did actually read the script, and I was a bit worried that we weren't going to get a mention of Dangote in, to be honest. So thank you, Jorge, for that. I'm really happy.
Okay, yeah. And if you want, we can move to this year outlook, to Q1.
Q1 would be great.
Okay, so once, we have talked about what has been 2025. We are at the same levels that how we start the year. So what are our thoughts for Q1 and also for the first half of next year? So as I have already said, we expect a strong East West level to persist. I don't think like the average of Q1 will be in plus 40, but I don't think it will be far away from it. So that's one of the big headlines. Asia will keep needing products from the East. Europe will keep exporting, and we expect US to increase the volume that goes there. That's not something from Q1, that's something structural. The more NGL that is produced in the US Gulf Coast, the more they have a net long position, and Asia will keep adding more and more steam crackers and demanding more naphtha. And US Gulf Coast is in a very good position to cover this. So I would say these are the very, the stronger headlines that we have for Q1. Then in the very short term, for the next 2-3 weeks, I think the market is right now in a bearish point. We have been talking about that for the last 2-3 weeks in our reports, but it's obviously linked to the macroeconomic environment and crude trading below 60s. But we have some fundamental reasons also for the Naphtha market. Mainly, we have a very weak US Gulf Coast market linked to the too high PAD 3 stocks. And then we have not a very strong local demand in Europe. And the arbitrage is not working that well as it has been during Q4. So combining this, we have a bearish view for the next week. But I think East West will keep supporting the market during Q1. Yep. And we can finish with like the main point for Q1 or for 2026 that could massively impact the market and change everything I have said. Yeah. So, first point we have, this is not that strong, but or that is not a surprise, but we are seeing very strong runs in US Gulf Coast. Stocks are building quickly in PAD 3, so the refinery margins are very good. So this could keep impacting in lower premiums in US Gulf Coast and being more bearish. Then we have, Neil have already talked about Russia. I don't think we have any answer, but if something would change, that would mean Russia will be able to export more, and that would be bearish for East West. And the same for the Red Sea. We haven't talked about it, but recently we've seen some reports, some news talking about if the Red Sea will become available again in the short term.
Yeah, indeed.
I think we've been reading this for the last 6 months, but right now it's been more and more, and that would be also bearish for the East West. And then the last thing, and I'm going to finish with this, is we've seen a lot of swings in the market coming from the US-China trade war. It has a very strong impact in NGLs, mainly in propane and ethane, but it also impacts butane and naphtha. So I don't think it's fully over. So maybe we can see more changes in this conversation during 2026.
2026 is going to be super interesting for Naphtha. I mean, 2025, your recap, as you said, you've hit some real highs and some real lows in that market. So the volatility has certainly been there. But one to watch kind of going forward. Okay, thank you so much for that, Jorge. Time for gasoline then. Let's finish the clean sides of the barrels. So gasoline, because of course it couldn't let Naphtha and Distillate have all the drama this year. Phil, looking forward to hearing from you for your rundown of 2025 and what we're watching for in Q1.
Sure. Just to assuage any issues or concerns about not hearing the word Dangote on the podcast, I'm on this week. Don't worry. You can tick off your bingo card as soon as you see that I'm on the pod.
I am delighted. Christmas has come early.
2025 recap. Keep it brief. Similar to Naphtha, so been a year of two halves. The first half of the year kind of kicked off with, I think the main story was physical markets struggling to keep up with paper strength. So we had very strong gas snap, and we were talking about why components weren't necessarily following the same trajectory that they were over 23 and 24. And we had EBOB spreads that were very average, right? We were kind of back to 2019 levels. It all felt as though we'd calmed down versus the previous couple of years. And so as the year then progressed, and it's similar, it was kind of July, August time, I suppose, where we saw this turnaround. But we had this story of essentially gradually tightening supply. We had refineries across Europe going off, as well as RFCC issues, not just in West Africa, but globally, honestly. The second half of this year, it's barely a week goes by without hearing of some RFCC somewhere that is malfunctioning, which I probably not going to talk about too much fuel oil today, but it's been contributing to low sulfur fuel oil being particularly weak. And so, second half of 2025, with those closures in Europe, with demand generally looking pretty good, continued growth there. The strength, though, was largely focused in Europe, or on EBOB rather, as opposed to RBOB or Sing 92, which meant that we had particularly kind of almost historically weak TA-ARB as well as East-West levels through the second half of this year. And that has eventually now, or is starting to come back and be seen as we get towards the end of the year, and we have supply returning in Europe post a particularly heavy turnaround period, in that we are seeing now basically no outlets for European gasoline, and the focus is turning to storage, which as it typically would or should have done already a couple of weeks ago. And so now we're looking kind of, if we want to talk about what to look out for in Q1 next year, it's about whether or not this contango that we've finally reached is enough, and what that's going to mean in terms of whether we're building enough before we can get constructive again in Q2. So I suppose, if looking ahead, worth pointing out the discrepancy essentially within the Atlantic between Europe and PAD 3 in particular, or the dynamic, let's say, between Europe, PAD 1 and PAD 3. So the very weak TA-ARB that we've been seeing has cut off a lot of even kind of baseline flow, it seems, moving from Europe into PAD 1. So there's going to be a question, as there has been for much of the year, essentially, of whether or not PAD 1 is going to be supplied sufficiently just with component ARBs and naphtha ARBs. Right, so heavy naphtha ARBs and kind of direct reformate, for example, or alkylate ARBs into PAD 1. 2026 promises to be the year where we get the New York blender up and running in the platform. So we'll keep people posted when we look at hopefully kind of component ARB levels as well going on there. And elsewhere, obviously, favourite topic, not going to get away from it. That Dangote RFCC is on turnaround at the moment, scheduled to come out end of January, early February. Confidence level, at least my personal confidence level in the return to fully functioning, absolute smooth running through the whole of 2026 is very low. We shall see when we get there, but yes. So, and I don't think confidence in that unit kind of running smoothly broadly is particularly high. So where does that leave European gasoline going into Q1 and going into 2026 in general? I think it's fair to say that we built a bit of a narrative, I say we, myself and market generally, of Europe being extremely tight, and particularly gasoline back in November. Obviously, prompt barge diffs were up in the 80s. I think as supply has come back and we've moved into contango now, it's probably fair to say that narrative maybe went a little bit too far. But it is fair to say that obviously, just structurally, demand is good. Demand may improve on lower outright prices. Neil, as you mentioned at the beginning, maybe there's a scenario where gasoline demand does not do well. We have a kind of broader macro slowdown. Let's see. So that can go either way. But on the supply side, obviously, we are, especially in the Western Suez, we are constrained, with the exception of Pad 3.
Yeah.
So Pad 3 continues to look as though it is able and willing to supply anybody that wants it. At the moment, that is including places like Australia. So I would expect that to eventually keep Pad 3 balances in check. It means that the TAR is probably going to need to rise a little bit to help Pad 1. But for now, it's max Pad 3 exports and keeping an eye then, I suppose, in Q1 on how Pad 3 manages to both play that role of marginal supplier to half the world, as well as build stocks that it needs itself before we go into Q2.
Great. Thank you so much for that, Phil. I think that completes kind of the light ends part of the barrel. So a few questions to be asked, and we'll definitely follow up on some of these bullish trends as well. So look, finally, crude. Neil, you're back on the box. So the market equivalent of a soap opera this year, we should say. Do you want to take us through 2025 rewind, and then why don't we chat around how ugly Q1 could get?
Yeah. I guess I start off by saying I told you that Brent would break through $60 on the 16th of December. I told you that 9 months ago.
Okay.
Now, obviously, it's been super hard to understand all kinds of timings and super hard to trade because it feels like we've had the glut narrative for so long and it was just so slow in showing up. I think we got some things right. I think we kind of correctly called that the summer wouldn't be quite as loose as the paper balance might suggest if you're just looking at OPEC targets versus OPEC supply to market. And then we started to think more about the glut emerging post-summer, but I guess it took longer than I thought possible to emerge. But I think it's probably fair to say it's now here. We don't have super deep contango yet. I can talk about that in a minute. But obviously, flat price spreads do speak for a bit of a change. There's other things that are happening in the physical market now, right? So Dubai, we mentioned this in contango. The start of the Asian cycle was basically yesterday with the Al Shaheen tenders. So we're hearing it's about the level that we've been anticipating, or 30 cents over Dubai. That's miles weaker. And it's so weak that, even a kind of 5-year low Arab light OSP begins to look a bit expensive currently. So I think there's more pain to come. I think that tells the correct story. Russian barrels are going to flow. There's too much incremental supply. There's not enough incremental demand. And full stop. Unless headlines blow it all up. Of course, that's always the caveat. How bad does it get? I would just say what I've said the last 2 weeks. If we're anywhere close to what the paper balance suggests, that everybody appears to agree on, we're 2 to 4 million barrels per day long. If we're anywhere close to that, then 20 cents backward in Brent is not the correct price. And all else equal, we need to price to store. I know there's contango down the curve, but you want prompt contango as well.
Yeah.
And flat price can kind of do what it wants to also on the back of that. And I know I sort of jokingly said $30, but if we are 3 million barrels a day long, it's not outside the realm of possibility, right? Yeah. And after a certain point, it doesn't matter how long you are. It was a bit like during COVID. I think at some stage, a few months in 2020, we were like 15 million barrels per day long. And I remember asking the question at that point in time, does it matter if you're 5 or 10? What does that mean for price? It doesn't mean that much after a certain point. And if paper balances are miles off that point and we're only 500 long, I have to ask the existential question, what the hell do we do paper balances for? Or not us, but the market. So I think it gets worse, all else equal. And physical crude diffs also need to start to reflect that, right? I'm noting that North Sea diffs haven't really done much, actually. Maybe that's slow trading. Maybe that's, kind of timing difference between Asia and Europe. Maybe there's lingering tightness from CPC and stuff like that. But I
I think
think
it's
the North
probably
Sea
all of the
diffs.
above. Yeah.
Yeah.
I think it could be a combination of all of the above as well, to be honest. And look, we've only got kind of a few days left going into next week as well. People are conscious about making sure that it's steady state throughout the festive break and covering kind of what they need to for now, I think.
Yeah.
Yeah,
And it will depend on structure, right? I mean, the way that the data Brent, I'm not a super expert on this, but I guess I had to look into it a lot over the last year. The way that the data Brent fobs are basically created depends on CFD structure, right? So if we end up in contango, the North Sea diffs basically have to come off. So two other things. What is the kind of medium-term ARB outlook in this environment? And I think in these situations, you kind of want to go back to the basics. The West is long, the East is short, right?
Yeah.
And that tends to speak for Brent and TI needing to price down so that they can try to clear somewhere, or they need a worse contango, let's say, to try to store. And you try and send that stuff east, and kind of time value of money becomes a bigger issue. And I wanted to say on that point, probably the most reactive producer is OPEC rather than shale, which might have been slightly different 5 years ago. Now they run on different economics, but I would expect if we stay with a kind of 50 handle, we will get some market supportive statements from the group.
Yeah.
And the next thing I would do, I think I said last week, I would try and actually quietly reduce exports. And after that, the next option is to say officially to the market so that Bloomberg can pick it up. Hey, we're going to actually reduce the target.
Okay.
That comes later, maybe. Yes. So that's kind of, I guess, the base case. It seems like the fairy tale might actually come true.
Fair enough. Key turning points for the crude market, do you think?
Yeah, I don't know where they are. I think I was trying to say it perhaps in a not particularly eloquent way last week, but I think it's a fair statement to say that when the market has a big problem, the things that rebalance the market actually speed up. And so even if you are 4 million barrels per day long, you need to break this up into chunks. OPEC might do something. China might increase their SPR. The US might come into the market to buy SPR. I don't think it's a coincidence. Well, it might be a coincidence, but it's a funny one. It's a funny coincidence that Brent goes to 59 and then the very next day, Trump announces there's an embargo on Venezuelan oil. There's an element, and I don't want to stray too far into the political, but it seems like there's an element of orchestration going on. And then maybe you get a touch more demand, and all this kind of stuff takes a chunk out of this length, and it can be that the narrative is actually quite different. So let's check back in June, July 2026 and see what the narrative is, because I think it can change quickly. You just need to stack up a bunch of stuff.
Yeah.
But yeah, the stars need to align.
Fair enough. We've got a maintenance period as well coming up between then. So that's another one to watch, kind of going into the end of Q1. Okay, thank you all. That was a real thorough kind of 2025 look back and what a year it has been, but also kind of there's some pointers there for Q1. I appreciate kind of everyone's getting ready for the festive break, and I'm sure everyone's pretty exhausted by how 2025 has played out across all the commodity classes. So look, that's it. So that's us for the final Trade with Conviction of 2025. Look, as always, thank you for spending part of your week and your year with us. The market doesn't slow down just because it's the festive break, and neither will the fundamentals. Distillates are tight, crude is wobbling, Naphtha's a little bit confused, and Q1 is shaping up to be a proper test of supply discipline versus demand elasticity by the sounds of it. So look, we're going to be watching every turn, the sanctions tightening, the peace deal noise, the refinery maintenance wave, and of course the cracks. If anything spikes, you will hear it from us first, I promise. So look, from all of us at Sparta, have a brilliant break, trade responsibly during this period, and come back ready for 26 that promises, well, absolutely no less drama than this year, I'm more than sure. So look, thank you for listening, and we'll see you in January.